A tumultuous week for stocks ended with all three of Wall Street's main indexes closing lower as an unfolding crisis in the banking sector grabbed headlines and spooked investors. The Dow and S&P 500 both dropped just over 1%, while the Nasdaq lost 0.75%. Shares of First Republic Bank plunged nearly 33% after it announced it was suspending its dividend, reversing Thursday's surge that was sparked by an unprecedented $30 billion rescue package from large financial institutions. Peers PacWest and Western Alliance also both ended the session sharply lower. It was the latest development in an ongoing drama that began last week with the collapse of Silicon Valley Bank and Signature Bank, which sparked fears of contagion throughout the global banking system. SVB Financial, parent of Silicon Valley Bank, announced Friday it would seek Chapter 11 bankruptcy protection. Concerns have spread to Europe as Credit Suisse shares stumbled over liquidity worries, prompting policymakers to scramble to reassure markets. U.S.-traded shares of Credit Suisse also slid. Investors now turn their gaze to the Federal Reserve's two-day monetary policy meeting next week. In view of the unfolding banking crisis, some investors think the Fed might pause its rate hikes, something Anna Rathbun, Chief Investment Officer at CBIZ Investment Advisory Services, says could hurt the central bank's credibility.
I'm not entirely sure that we should be expecting the Fed to pause. Because again, inflation's sticky, employment is still strong, and other central banks are looking beyond the banking issues to tame inflation. So the Fed's credibility depends on this. We also probably won't see the Fed saying that we were wrong and therefore we need to pause, right? That's another credibility issue. The Fed probably also does not want to say inflation is not important anymore, because then they're just focusing just on banks and not on everyday Americans.
On the upside on Friday, shares of FedEx jumped after the package carrier hiked its current fiscal year forecast. One day after a $30 billion lifeline boosted its beleaguered shares, First Republic Bank saw its stock price plummet more than 25% on Friday, with trading temporarily halted, as new information about the bank's finances reignited investors' fears of a broader banking crisis. First Republic's Friday stock plunge came after the San Francisco lender said it was suspending dividend payments to its shareholders. It also disclosed recent changes to its balance sheet, including a more than $100 billion loan from the U.S. Federal Reserve that one analyst described to Reuters as, quote, staggering and painting a very dire outlook for the bank and its shareholders. First Republic's roller coaster ride began earlier in the week when investors feared it may be the next to fall after the collapse of SVB Financial and Signature Bank. Big banks including J.P. Morgan Chase and Morgan Stanley stepped in with the $30 billion lifeline in a deal that was put together by power brokers including J.P. Morgan CEO Jamie Dimon, Federal Reserve Chairman Jerome Powell, and U.S. Treasury Secretary Janet Yellen.
Our banking system is sound.
The renewed fears of a First Republic collapse came even after Yellen on Thursday assured lawmakers that the U.S. banking system was sound. But what a difference a day makes, with other embroiled banks on Friday also making news. SVB, whose former unit Silicon Valley Bank was taken over by U.S. regulators, said on Friday it had filed for Chapter 11 bankruptcy protection to seek buyers for its assets. And Credit Suisse shares came under renewed pressure despite the bank having secured an emergency loan of up to $54 billion from the Swiss National Bank. Renewed worries about the sector sank other bank stocks Friday and helped drag down Wall Street's main indexes. Fed data showed that banks sought a record $152.9 billion in emergency liquidity from the Federal Reserve over recent days, surpassing the previous high that was set during the most acute phase of the 2008 financial crisis.
Batteries are the new battleground for big car makers. Now Volkswagen is taking radical steps to secure its own supplies of vital raw materials. On Friday, the German giant said it would start investing in mines. Like rivals, it wants greater control over a supply chain normally left to third parties. VW hopes to bring down its costs, meet half of its own needs, and sell to other makers. The aim is to make its PowerCo battery unit a global supplier to the industry. It will start by delivering cells to Ford for cars it makes in Europe. For now, VW would only say that it is partnering with miners in Canada, where it will build its first North American battery plant. It didn't say which locations might come next. Few automakers have disclosed direct investment in mines, though many have struck deals to secure supplies of raw materials like lithium and cobalt. But acquiring batteries at reasonable cost is now a huge challenge for the industry. VW's PowerCo unit is targeting sales of over $21 billion by 2030.